Datavault AI Inc. closed its last trading session on Monday, June 8, 2026, at exactly $0.43 per share, marked by intense intraday volatility that saw the stock oscillate between a high of $0.45 and a low of $0.42. With the market currently closed, this $0.43 price tag represents the definitive standing ground for a company that has found itself deeply entangled in a fierce battle between narrative expectations and stark financial data. The immediate underlying reality that many retail market participants completely miss when looking at this sub-dollar pricing is that Datavault AI Inc. is currently navigating an active securities law investigation. Law firms are aggressively circling the company following a highly critical report published by short seller firm Wolfpack Research, which has triggered massive institutional scrutiny and fundamentally broken the stock's upward traction. The overarching market narrative around this microcap asset has long been fueled by massive promises of a major structural shift in data tracking. Retail platforms like Robinhood app and individual brokerage accounts across the globe saw a massive surge in retail buying interest when the company announced a massive $2 billion structured financing term sheet with an exclusive global tokenization mandate. The expectation was that this massive influx of capital would instantly legitimize their proprietary digital asset validation network. However, the reality hidden deep within the official financial statements presents an incredibly stark contrast that has left many self-investing participants exposed. While management repeatedly highlighted an absolute surge in theoretical signed tokenization contracts, their actual recognized revenue for the first quarter of the year came in at an incredibly modest $3.4 million. This figure fell entirely short of the $20 million expectation that Wall Street analysts had penciled into their growth assumptions, creating a massive vacuum between corporate promises and actual cash flows. This immense friction between expectation and reality has triggered a profound recalibration across top online investing channels. If you monitor high-end institutional sentiment on platforms like the Interactive Brokers platform or check the comprehensive data dashboards on Fidelity Investments, the skepticism is palpable. The general belief among speculative bulls was that the company's recent rebranding from its former identity as WISA Technologies Inc. into Datavault AI Inc. would completely clear the slate, allowing it to escape its historical reputation as a struggling wireless audio semiconductor play and emerge as a clean slate artificial intelligence leader. The reality, however, is that a simple corporate name change cannot alter basic balance sheet mechanics. The company has been burning through cash at an accelerating rate, with total operating expenses ballooning to over $31 million in the latest quarter, driven largely by skyrocketing selling, general, and administrative costs that reached $25.33 million. This massive spike in structural overhead brings us straight into the core of the ongoing trading dynamics. When you look at the recent trading volumes, which have frequently cleared the 50 million share threshold in daily swings, it becomes clear that this is no longer a passive long-term asset. It has turned into a high-stakes battleground for short sellers and momentum traders utilizing low-cost platforms like the Robinhood app or utilizing advanced margin accounts on the Interactive Brokers trading desk. Institutional ownership has remained exceptionally thin, as major asset managers who typically handle high-volume Fidelity mutual funds or core Fidelity ETFs tend to avoid microcap companies with negative earnings per share figures sitting at minus $0.96. Comment below how many shares of Datavault AI Inc. you currently hold, or if you are entirely avoiding microcap tech right now. To truly understand why the stock is sitting at $0.43, we have to look closely at the macroeconomic pressures squeezing companies of this exact size. In a higher-for-longer interest rate environment, small-cap tech firms lose their ability to secure cheap debt. This forces them to look for alternative financing structures that often come with severe catches. Datavault's announced $2 billion term sheet is a prime example of this exact dynamic. While the headline number sounds incredibly massive and sent speculative shockwaves through online investing communities, the structural reality behind such agreements almost always involves significant share dilution, warrants, or a substantial shift in corporate control that penalizes existing individual brokerage holders. This is precisely why institutional trading on platforms like Interactive Brokers stock trading showed immediate selling volume following the initial press release. Smart market participants realized that the headline asset numbers did not match immediate balance sheet liquidity. Let us trace back the structural lineage of this company to see how it ended up in this exact operational position. Long before it was marketed as a high-tech data tokenization exchange, the company was founded back in 2010 as Summit Semiconductor LLC, later transitioning into Summit Wireless Technologies, and eventually WISA Technologies Inc. For over a decade, its core business model was built entirely around manufacturing high-fidelity wireless audio modules and home theater synchronization systems. The corporate pivot occurred when the company completed an asset purchase from a privately held entity called Datavault Holdings Inc. That transaction is what officially prompted the massive rebranding. The company shifted its entire narrative from hardware manufacturing to a highly speculative cloud-based framework split between acoustic science and data science. They began promoting proprietary platforms like DataValue and DataScore, claiming to bridge the gap between physical real-world objects and immutable digital ledger tracking. This dual corporate identity is exactly what caught the attention of short sellers like Wolfpack Research, who openly alleged that the company was using popular tech buzzwords to artificially inflate its market capitalization while masking a structurally unprofitable legacy hardware operation. The company fought back aggressively, retaining top-tier legal counsel and filing an official defamation lawsuit against the short-selling firm in federal court, claiming that the critical report relied on distorted data, cherry-picked public documentation, and a fundamental misunderstanding of their underlying technology licenses. This ongoing litigation has added a massive layer of legal uncertainty that completely repels traditional conservative wealth managers. If you browse through standard investment help portals or use automated tools like Schwab Intelligent Portfolios, you will notice that highly volatile microcap stocks facing active short seller litigation and parallel law firm investigations are systematically excluded from diversified portfolios due to extreme tail risk. The structural reality of their quarterly performance shows just how difficult this transition has been. While their third quarter performance last year showed a dramatic spike in revenue to $33.82 million due to sudden asset integrations, the subsequent quarters showed a precipitous drop, falling right back down to $3.42 million. This extreme inconsistency makes it nearly impossible for traditional quantitative algorithms used in online investment systems to establish a reliable baseline valuation. When an online investing platform or a Fidelity brokerage account updates its core metrics, a beta value of 0.29 might suggest low systemic correlation, but the actual local MSCI pricing is incredibly high, driven entirely by corporate press releases and regulatory filings rather than broader macroeconomic trends. For retail investors managing their own accounts through self-investing strategies on a standard mobile app, distinguishing between an actual operational turnaround and a speculative narrative cycle is the ultimate test. The expectation planted by corporate communications is that Datavault AI Inc. possesses an unshakable intellectual property moat consisting of over 70 domestic and international patents covering spatial audio tracking and decentralized data security frameworks. The reality, however, is that an intellectual property portfolio is only as valuable as the immediate commercial licensing revenue it generates. With a cost of goods sold sitting at $3.3 million against that $3.42 million in quarterly revenue, the actual gross margins on their current operations are razor thin, leaving almost nothing to cover their massive $5.73 million research and development budget, let alone their towering administrative expenses. This brings our focus squarely to the ultimate future outlook for the asset and the specific catalysts that could dictate its survival or its ultimate decline. There are two distinct structural scenarios that market participants must weigh carefully. In the bullish scenario, the company successfully converts its highly publicized $800 million pipeline of signed tokenization contracts into legally binding cash-generating revenue streams over the next 12 months. If they can execute on this operational front and clear their name in the ongoing legal disputes, the current $0.43 price would represent an incredibly deep valuation discount, potentially validating the aggressive $3 price targets issued by speculative Wall Street analysts. This outcome would instantly reward high-risk traders utilizing active trading platforms like SoFi Invest or active Robinhood investments. Conversely, the bearish reality cannot be ignored. If the structured $2 billion financing term sheet falls through, or if the terms of that financing result in a massive catastrophic share printing cycle that completely deletes existing individual brokerage positions, the stock faces an incredibly difficult path forward. Continued revenue misses below the consensus expectations of institutional analysts will likely force the company to execute additional reverse stock splits just to maintain its formal listing requirements on the NASDAQ capital market. Furthermore, if the expanding law firm investigations into potential securities law violations transition into formal regulatory actions, the company's access to traditional capital markets could dry up entirely. This would leave them with no choice but to rely on highly toxic dilutive financing mechanisms that historically decimate microcap technology equities. When you look at this asset through the lens of investment psychology, the lesson is clear. The massive tension between what investors wanted to believe, a small wireless audio company instantly transforming into a multi-billion-dollar leader, and the actual structural financial reality of a company generating limited revenue while running high administrative expenses is exactly what drove the stock down to its current level. For anyone utilizing modern online investing sites or managing long-term capital through an individual brokerage account, assets like this require an incredibly disciplined approach. In summary, Datavault AI Inc. stands as a prime case study of market expectation colliding directly with operational reality. The central insights point to a company trying to bridge a historic hardware past with a speculative digital future, caught in a high-stakes crossfire of short seller battles, mounting legal defense costs, and a massive gap between pipeline targets and actual recognized revenue.
While the technical patent portfolio and massive funding headlines offer a glimmer of speculative upside, the immediate balance sheet pressure and under-dollar pricing remind us that the market demands concrete financial proof before it grants structural legitimacy.